leading economic indicators have been negative for 13 months in a row. If we start to see an improvement in the leading economic index, that's going to be your first real telltale sign that we've probably seen a trough in the downturn of the economic data. But here's what you need to know before the bell this morning. The market, of course, has been rallying very strongly here over the last, last 2 months in particular. We've had a very, very sharp advance. Markets have gotten very extended. Relative strength on a variety of fronts are now really, really in overbought territory. Once we get above about 70, typically that gets you to that more overbought status in the markets where you start expecting at least a short-term correction. Now, this expansion in the market, of course, has gotten us well into 3 standard deviation territory. The sell-off on Friday, again, markets were closed on Monday. So the sell-off that started on Friday looks to continue at least a little bit this morning at the open. So again, there's a bit of room here for the markets to correct and work off some of the short-term overbought condition and not even threaten the bullish uptrend. So again, we've been expecting a corrective action in the markets that would allow us to put some capital to work when we get to that point. But again, we're just kind of starting this process. We need to work off some of this overbought extended condition. Again, lots of support. 4250 on the S&P 500, 4170. That's the 50-day moving average right now. Those are going to move up here over the course of the next couple of weeks as we continue to progress forward. But those are kind of your key technical supports to start looking at. You can get all the way down to 4,000, 3970 on the S&P. That's the 200-day moving average. Again, and once we get to that point, if we get down to the 200-day moving average, which is entirely possible, that's about a 9% decline from where we are now, you're going to get a lot of talk about, that was a bull trap. Now investors are back in the bear market. And that's not going to be the case at all. A correction back to the 200-day moving average, completely fine, keeps you within the bullish trend, and it gives you that ability for markets to advance through the end of the year. But again, you're going to need a correction here to work off some of this condition. Most reasonable expectations are somewhere between 4,000 4,100-ish on the index. That'll probably give you, kind of this really good overbought condition. Whether or not we get down that far is, of course, going to be very subject to what's happening in the markets. But a 5 to 10% correction in any given year, a bull market or bear market, certainly within context of norm. So as we get this kind of corrective action going, markets could consolidate sideways and allow those moving averages to catch up to price, or you're going to get a correction in price to some of those supports. That'll give you a much better opportunity to add some cash on the sidelines back into equity markets. But again, continue to monitor the overall risk. There's still some concerns. Like I said, don't dismiss the concerns entirely of higher interest rates, the impact on the economy. Those threats are certainly out there. But right now, the bullish trend is intact. We want to use that to our advantage. Look for pullbacks to do that, and you'll be a lot better off. I'm your host, Lance Roberts. That's what you need to know before the bell.